Hey, if you're a small business owner, I know you're hustling. You're focused on clients, on your product, on growth. But what if the biggest leak in your finances isn't a bad deal, but a simple reporting mistake you don't even know you're making? So let's dive into exactly how this happens, because getting this right could literally save you a fortune. Seriously, just think about that for a second. It sounds completely nuts, right? But for so many new entrepreneurs, this is exactly what's going on. You're trying to do the right thing, but you end up paying taxes that aren't even yours. And it is absolutely killing your business. Now look at this number. This is not some hypothetical. This is the real world difference for one single client between doing their books the easy way versus the correct way. That's the kind of money we're talking about here. And believe it or not, it all starts with one fundamental misunderstanding. So, what is this huge mistake that costs so much? Well, a lot of new business owners do something that seems logical. They just look at their bank statement, add up all the deposits, and say, okay, that's my income. It seems simple, but it's a massive trap that leads to overpaying by an insane amount. Here's the heart of the problem. The common mistake is thinking every single dollar that hits your business bank account is fresh, taxable income. But the reality, it's way more nuanced than that. A deposit might be revenue from a sale, for sure, but it could also just be you transferring money from your personal savings account. And that brings us to this crucial term, owner's equity. Think about it. If you move money from your personal savings into your business to cover expenses, you already paid income tax on that money when you first earned it. It is not new income. You should never, ever pay tax on it a second time just because you moved it from one pocket to the other. All right, so if your total deposits aren't your real income, then what is? Well, the first step to figuring out your actual taxable income is understanding one of the most powerful tools you have, your cost of goods sold. This is literally everything you spend directly to make your product or deliver your service. We're talking about supplies, raw materials, maybe the wages you pay to the people who are hands-on in creating what you sell. This isn't just some little deduction, it's a fundamental piece of calculating your actual income. And look at the impact here. It is huge. For some businesses, once you properly account for your cost of goods sold, it can slash your taxable income almost in half, right off the top. That's a massive win before you even get to any other expenses. Okay, so you've subtracted your COGS. What's next? Now we get to the next layer of savings, all those operating expenses and other deductions that people miss all the time. This is the proper flow, the right way to think about it. You start with your real revenue, take out your COGS, and then you start deducting all the other legitimate costs of running the business. This step-by-step approach makes sure you don't leave any money on the table. And here are some of the big ones that people just flat out forget. Are you renting an office or even just a piece of equipment? That's a deduction. Paying independent contractors? Deduction. If you're self-employed and paying for your own health insurance, that can be a huge deduction. And don't sleep on business mileage. It adds up way faster than you think. Now listen up, because this is absolutely critical. If you want to claim those expenses for contractors and rent, you have to issue a 1099 form. Why? Because that form proves you paid them, and it officially tells the government that the income and the responsibility to pay tax on it belongs to them, not you. If you don't do this, you are literally volunteering to pay someone else's taxes for them. Okay, let's put this all together and go back to that shocking number from the beginning. I want to show you exactly how this plays out with a real business. It's truly a tale of two completely different tax returns. So let's say a client has about $600,000 in total revenue. Using that easy method, they just count all their deposits and maybe list a few obvious deductions. The result? It's a financial catastrophe. Because their reported profit is so incredibly high, they get hit with a devastating double whammy. Not only do they owe a ton in regular income tax, but they also get slammed with the full self-employment tax on top of it. It's a brutal 1-2 punch. When you do the math, their effective tax rate is a staggering 50.3%. Think about that. More than half of their profit is going straight to taxes, all because of bad bookkeeping. And that leads to this, a federal tax bill of over $250,000, all because they mixed up their personal savings with income, didn't calculate COGS, and didn't document their deductions the right way. Now, for that exact same client with the same $600,000 in revenue, after we went through and applied the rules correctly, their federal tax bill, including FICA, was less than $300. That is the power of knowing the rules. The difference isn't just big, it's life-changing. I know what you might be thinking. How is that even possible? Is that sketchy? And the answer is absolutely 100% yes, it's possible, and no, it's not sketchy at all. This isn't about finding weird loopholes, it's about having an ethical advantage simply by understanding and following the tax code as it's written. And I really want you to let this sink in. You do not have to act sketchy to have a good tax return. You don't have to hide things or put your family at risk. Smart tax strategy is all about honest, careful, and correct reporting. This is what it all comes down to. The tax code lays out the rules of the game. You are not obligated to pay a single penny more than what the rules say you owe. Your moral obligation is to be honest, not to overpay just because you didn't know any better. So I'll leave you with this question to think about. That tax bill. The difference between paying a few $100s and a few $100,000. What could you invest back into your business, into your family, your community, your future? Getting this right isn't just smart. It's empowering.